It's another wrap for the week ending Friday the 24th of November. This week, after Matt's macro summary, instead of running through a particular stock that we like, I thought this week I'd follow on from last week's news in Santos and Woodside and give you a take on the oil and gas sector, finishing with our thoughts on the major players. As always, please note that our comments are general in nature, and please speak to your Edward Street advisor if you wish to know if any of the following stock recommendations suit your personal needs and objectives. Over to Matt for his usual macro summary for the week. Matt?
Yeah, thanks Brad. A bit more relaxed this week in these chairs. It's been a busy month on the markets this week and plenty to report. Over in the US, the roll continues with the Dow Jones and the Nasdaq still making new highs. The run continues to be fueled by Trump's proposed lower corporate tax rate, clearly being a positive for the market. At Edward Street, we get asked plenty of questions as to when this incredible bull run will end, which is a very hard question for us to answer, as markets can extend above expectations on the upside as well as on the downside. And with lots of investor flows into ETFs in the US market, it continues to be artificially popped higher. So we suggest just continuing with the old favourite analogy, which is the trend is your friend until it bends, and suggest sticking with the run until it turns. And for advice as to when it turns, well, I guess you'll have to keep watching our videos for that. Locally, our market has finally had a piece of the action, running up to 6,000 points. The mining stocks, including BHP and Rio, have helped steer the market north, helped by a falling Australian dollar, which traded as low as 75.3 cents this week. I note the gold price has not done a lot since trading below 1,300, as speculators are focusing on Bitcoin instead. However, the lower Aussie dollar has seen the local gold miners trade considerably higher, with Newcrest nearly $24. Copper has held steady around $3.20 a pound, with Oz Minerals trading at around $8.50. And as Brad will mention later, oil has been the big winner, with West Texas Intermediate trading up to $58.50 overnight, helping fuel the sector. Even though our market has been improving nicely, it still pays to use professional advice, as there are still many landmines going off each day, and sometimes it's more about the ones you miss than the ones that you win. This week I've seen at least 3 stocks have some pretty ugly falls, being Webjet, Coca-Cola and McPherson's. And if you've followed the earlier saying about exiting when the trends turn, you probably would have missed all 3 downgrades. So where to from here? Our market appears to be consolidating around the 6,000 point level. It could even drop a couple of hundred points and still remain in the uptrend. As mentioned in earlier videos, we are now in a seasonally strong period for markets, and based on history, if interest rates can remain on hold, we remain comfortable with market conditions potentially up until May next year. Thanks, Brad.
The gradual recovery in oil has taken a big step forward over the last few months, with Brent and WTI oil prices rising 38% and 33% respectively since July. For about 2 years now, we've been talking about an expectation that the oil price would gradually improve once the market returned to balanced supply, and that is global oil production minus total oil consumption. This view remains intact, and we expect all fundamentals have now improved to the extent that the future supply interruptions will start to have a much larger positive impact on oil prices, while bearish developments will have a smaller negative impact. As the global market is now better positioned to absorb supply additions and likewise more sensitive to supply interruptions, this has resulted in oil prices becoming more sensitive to market catalysts such as the tensions in the Middle East. Not surprising, given the level of previous pessimism towards the oil price, 12-month oil price forecasts from the vast majority of global banks now sit well below where oil prices are. While oil will no doubt remain volatile, it is an important positive indicator that the current oil price is well above priced-in expectations, which will likely result in supportive consensus earnings per share upgrades for the oil and gas stocks over the coming months. So our thoughts on the major players. Santos. As I pointed out last week, the share price has rallied hard on media speculation that the subsidiary of US fund EIG was preparing to make a $5.10 per share cash offer. Since then, some cold water has been poured on the potential for a formal bid emerging following confirmation from Santos that it had knocked back a lower offer of $4.55, in addition to comments from South Australian government that it would block any bid given its desire to keep Santos Australian owned. We believe Santos may be motivated to use its now higher share price to one, defend against any offer, and two, help improve its undersized gas reserves underpinning GLNG. We expect Santos may seek to do this through either using its scrip to acquire smaller gas developers / assets, and or by pursuing other equity raising so it can get more aggressive with its development activity. Combined with a 38% surge in oil prices, we believe recent developments have created the opportunity environment for people to reduce their positions in Santos. Woodside. A positive development from the last month has been the well overdue exit of Shell from Woodside shareholder register. The global major was clearly motivated by price to exit its remaining 10% position in Woodside, with the sale forming part of a larger multi-year divestment program by Shell to strengthen its balance sheet. The removal of the overhang boasts free float in Woodside. Woodside is a good operator with strong earnings power. However, the recent rise in oil prices carried Woodside's share price to levels we see as fully valued. We see Woodside as offering a less volatile way to play oil, given its mature operations, for the seeking long-term exposure to the commodity. Oil Search. Like the rest of the market, we're very surprised when Oil Search announced its recent acquisition of an interest in a global-scale greenfield oil play in Alaska. However, Oil Search management has since done a great job of walking the market through its rationale for the investment and how it fits into the overarching strategy. Being long-term oil bulls, we find it hard to dislike cheap greenfield acquisitions of large scalable oil resources. However, there is always the concern that the surprise acquisition could increase chances of Oil Search needing to source equity at some point to fund combined PNG/Alaska development plans. Active investors have made large returns off playing Oil Search's well-defined trading range. Although it's worth noting that we expect Oil Search share price to finally break through this range over the next 4 to 6 months as key hurdles are removed, Oil Search remains our top pick in the large cap energy space. In terms of corporate actions, on Wednesday next week, ALS goes ex-dividend 8 cents after a result that was a slight miss versus market expectations, and GrainCorp also goes ex-dividend 15 cents fully franked. That's it for another wrap. Please feel free to share this video with your colleagues and friends, and make sure you like the Morgans Edward Street Stockbroking Facebook page. Also, subscribe to our YouTube channel below. Have a great week.